Again, thank you, everyone. Thank you, Rampver Financial, for giving me the opportunity to share how we think and how we see the market for the coming year. Past 2022, I also did this market outlook, and it was a bit tough. We were coming off a period wherein the all global and the local assets were both suffering from negative returns, as we've experienced a lot of shocks. There was an inflation shock because supply chains were disrupted. And as a result, global central banks raised their interest rates, which again delivered another interest rate shock. And to add to that, there was a curveball. Russia-Ukraine happened. So this pushed commodity prices higher. So a lot of these shocks factored into the negative global equity and fixed income performance last year. So coming into the year, we were a bit cautious. We were thinking, after that very steep tightening cycle, are we in for a recovery, or are we about to enter the second phase of the bear market, wherein the real economy felt the brunt of the tightening and the restraint that global central banks were putting on the global economy? And hence my presentation entitled, "Are We There Yet? Recession or Recovery in the Cards?" So, admittedly, we were quite surprised at the start for the first half of the year, but it was a pleasant surprise. We saw both global equities and fixed income rise and return positively. You saw global equities, as represented by MSCI ACWI, return 7.6%, led by developed markets. You have the S&P 500, the US benchmark index, up by 8%. Euro Stock 600, the European benchmark, up by 7%. And you have global fixed income returning 2.5% after the previous year's negative performance. You also have emerging markets also following suit, but at a slower pace. You have emerging markets returning 1.5%. And this has largely to do with China not being able to at least meet investor expectation with respect to their opening. Unfortunately, our PSEI, or our local benchmark, still lags. It has returned, it's flat and has returned -1% year to date. So what could be the possible driver of the positive equity performance return? And a lot of this had to do with the global economy being able to at least avert a recession. Start of the year, you have market participants all forecasting very bleak and gloomy outlooks. No, both developed markets, US and Europe, after that inflation and interest rate shocks, were poised to deliver negative growth. And you saw them in the forecast that the market participants were giving out. The yellow bars show the 2022 performance, and the dark blue bars, show 2023. What's notable is until when I made this chart, both US and Europe were able to avoid recession, but it was noticeable that growth has slowed. On the other hand, you have the emerging markets, Asia ex-Japan, China, Hong Kong, India, who are a bit counter-cyclical in their business cycle. They were coming from a reopening, especially China. And so the investors were forecasting growth to move higher. So if you notice, 2022, the yellow bar, what is lower than what is being estimated in 2023 for both Asia, Japan, and China. So given that backdrop, with developed markets being able to avoid the recession, and China, Japan, and the entire Asian region opening up, that allowed for at least synchronized global expansion for the first half of this year. Do note that when we were approaching 2023, both US and the Eurozone were expected to go into recession, but this did not materialize. And so that gave some positive tailwinds to the market. So what happened? Why did the US, quote unquote, avoid a recession? A lot of it has to do with the labor market. So you have a spike in CPI up to 9.1% last June, I believe. And of course, central banks had to react, especially the Fed. They had to raise interest rates by 500 basis points. So what that did is that restrained demand. Both on the demand side, you have consumers spending less, borrowing less, and you have also the supply side, your businesses putting off expansion plans. But what we saw is a lot of that CPI increase had to do with supply disruptions. So it's largely when commodity prices drop, a lot of it went away as well, and supply chains opened up. A lot of it went as well. There were other factors in the US, namely the US labor market, which is still which is still supporting some inflation, especially on the core inflation level. So you have record unemployment rates in the US, and this temporarily supports US consumption. So the chart to your right shows retail sales and average hourly earnings. So as long as US consumers have jobs, they would continue to spend, and that would fuel US expansion despite the tightening and despite the inflation that the economy has experienced over the past year. On top of that, more last quarter, you've heard of the recent bank failures. You've heard Signature Bank, SVB, a lot of these regional banks facing liquidity issues because a lot of their depositors have been withdrawing cash and parking them elsewhere where they can enjoy higher rates. So this tightened credit conditions. What that means is banks are now less willing to lend, and this also puts a bit of headwinds into the US economy. So all in all, we're seeing some slowdown in the US economy brought about by inflation, monetary tightening, but these are still not enough to cause a recession in the US because the labor market and the US consumer has been very strong. So on to China. We saw fourth quarter of last year, we saw a China reopening. They lifted zero COVID, and everyone was very optimistic, including us. We thought China would be able to deliver and go back to its growth clip pre-pandemic. But as the data has been coming out the previous the first half of this year, that hasn't materialized. These charts on top are PMIs, which is an indicator of manufacturing performance. At the bottom as well, PMIs. We see drop off from the initial surge from the reopening during the 4Q of last year and 1Q. PMIs have sort of dropped off. A lot of this has to do with the slowing demand in other developed markets. Of course, China, being the global factory of the world, is hampered whenever demand is a bit slower in other markets. But also it has to do with the lack of confidence that both the consumer and the business sector has on the economy and on the growth path in China. More recently, there's been talk of stimulus to pump prime spending and to pump prime the economy. But until now, this has no formal announcement or formal steps have been taken by the Chinese government to be able to jumpstart the growth, as we see a lot of the economic indicators tapering off. Also, property market has been quite challenged in China. Property prices have been falling off since demand for new houses and for bigger houses have been also restrained, has been also pulling back. And so what that causes is a fall in house prices. With the bulk of the Chinese wealth in property prices, you see that affect the consumer confidence and the consumer sentiment. So people are willing to spend less because a bulk of their wealth, which is tied to property, is 20% or 30%, 40% lower. So that affects consumer demand as well. So when we look at which attractive markets to invest, one thing that we look at is earnings per share and earnings growth. So the chart to your right shows which markets deliver higher earnings. You notice a lot of the ones to the leftmost of the chart, these are emerging markets, and a lot to your right are developed markets, and that is understandable. We have what we call an earnings differential. As an emerging market, you are expected to deliver more earnings growth. That's because your economy grows faster, and for investors to be attracted to investing in your market, they would require, of course, a higher earnings growth. You'd notice China and Hong Kong top that list. And so that is understandable again, because it is coming out of lockdowns, and it is coming from a low base. But we believe that these markets are also at the risk, at the top of the list in terms of possible earnings downgrade, meaning they have a high probability that they might not deliver on the earnings that they've promised, on the earnings that the market is expected of them. What we need we've seen also a lot of downgrades in Asia, most notably Korea, Taiwan, even India. And what we need for flows to come back, for foreign investors who have access to other markets to come back to our part of the world, is for China to start delivering. Investors look at indices, and in emerging market indices, China holds a significant weight in that basket. And for investors, that's the first thing that they look at. China and its performance, that would attract as well other investors to take a look at other periphery countries once they see that China is delivering on its earnings potential and its growth trajectory. So another thing that we track is how expensive or cheap a market is. So last year, 2022, you saw discount rates move higher that pushed asset prices lower. So what we call a valuation reset. So the table to your left shows how much derating, how much lower the PEs of each market has been marked down just because of the increase in interest rates. Your yields move higher, they become more attractive, and hence equity prices move lower. So now, given that a lot of the change in asset prices happened last year, generally we see valuations this year as a bit more attractive than where it was the past year. It's a bit more respectable, palatable, so to speak. Of course, you still have the more quote-unquote safer markets, your developed markets, your US, especially the large cap tech sectors trading at very high multiples. But largely, it is the PE multiples of the different markets are lower from where they was the previous year. What does that mean? So if you are a long-term investor, especially if you have a 3 to 5 year horizon, it makes more sense to you to start investing now, because you're getting essentially these markets at a discount previously to where it was before. We also we ask ourselves which markets have the potential to be re-rated. And a personal pick of mine is Japan. It is, compared to other developed markets, it is a bit cheaper and it has a good re-rating story. So it is coming out from, as contrary to US and Europe, which was battling inflation. Inflation, it has not been a problem in Japan. On the other hand, it has been exiting deflation. What does this mean? If you're exiting from deflation, wages are on its way up. More higher wages, it means more spending power to the consumer. More spending power to the consumer, businesses would be attracted as well to expand. So this creates a very positive, the exit from deflation creates a very positive feedback loop for the economy. At the same time, it has been instituting reforms. I don't know, more recently, you've probably heard of Warren Buffett taking sizable positions into the top Japanese conglomerate. So year to date, Japan has been doing well, and the medium to long-term story of Japan looks quite attractive in our opinion. Another thing that we look at is the equity yield to bond yield spread. So we always compare which one, especially in balanced portfolios that we manage, we always compare, is the return that we're going to get on fixed income more attractive that from the return that we're going to get on equities? And we use an equity yield to bond yield tool for that. So for example, historically, the equity yield to bond yield is around 2.4 times. That accounts for different parts of the business cycle. Currently, the 10-year US Treasury is at 3.8%. So that becomes your bond yield. Your equity yield is the global equity benchmark, which is currently at 16 times. So right now, the current equity yield to bond yield is 1.7 times. For the relationship to hold, you would need either one of two things to happen. You'd need lower yields or the 10-year US Treasury to drop to 3%, or you would need multiples, the global equity multiple to compress to around 14 times. So from this level, that's around 10% downside. So effectively, that's your downside. That's what we think is the downside for global equities. One exercise that we do is that we look at, at the start of the year, we set an index target. This is our target, global equities target return for the year. You have our base case, 648. Currently, right now, it's the MSCI ACWI has passed this. And so we are still reviewing whether or not it merits an upgrade or not. But we still feel that the bull case, which is at 713 or around 9% from these levels, is still intact. The assumptions of the bull case is that inflation would continue to go down, would continue to be on a sustained downward path. You have the Fed taking a more balanced approach, meaning they would stop hiking and possibly signal a potential rate cut by 4Q. You also have, in this case, an assumption that the economy, the global economy, would hold up. So that would be a scenario that would be very supportive for risk assets and that we believe would help, would push the global equity index higher to around the 713 level. 9% from where we are now. So given the 3-ish% 10-year US Treasury rate, this accounts for the bull case would be 500, easily 500 to 600 basis points spread over that. So quite a healthy return potential, taking into consideration, of course, the additional risk that you'd be taking on by investing in global equities. Despite the optimism that my previous slides have been painting, there are still a lot of skeptics in this market. And these 4 charts show how the professional investment community and how the fund managers have been reacting. So the chart to your bottom right shows cash levels of professional investors. And they're close to GFC levels. Please note that we are very far from a GFC-like scenario. And yet, cash levels are at their highest practically since I started managing investments. The chart to your left, top left, shows how bearish investors are in terms of their asset allocation, meaning where are they invested? If they are invested, they are in cash and they are in fixed income. Because they expect some more choppiness, some more softness, a potential downturn. If they need to be invested into equities, they're underweight equities, and if they need to have exposure, they're in the defensive sectors. When I mean defensive, these are companies that have more predictable cash flows. Your utilities, your consumer staples, your healthcare. If they need to be, and of course, they are underweight the cyclical sectors. Your consumer discretionary, your information technology, your consumer services, your materials, those sectors. So there's a disconnect in the sense that on the one hand, You have an economy that's still okay. Inflation moving lower, Fed about to end its tightening cycle, and still global economy is still at 2%. But you have your professional investors still on the sidelines, waiting for a better entry point, or waiting if ever there will be blow-ups or more weakness in the global economy. So where are we positioned? So we understand that compared to where we were a year ago, the condition has vastly improved. Again, to reiterate, inflation is no longer a problem. It has peaked and its march lower. So this will put less pressure on the Fed and other central banks to at least balance their inflation and growth mandates. What 2022 has done, it has allowed a repricing. It has allowed assets to be cheaper, to derate. And this presents a valuable entry point for people who is looking to invest in global equities. Closer to home, Asia ex-Japan, and most especially the Philippines, need China to deliver on its earnings, on its growth path, growth trajectory, in order for fund flows to come back. Because right now, there are more alternatives for global fund managers, and the region is not as attractive compared to the others, or there are pockets of attractive opportunities. And unfortunately, the Philippines does not fare well in the prioritization as we speak. So various leading indicators still, this is a risk factor. We still see some signs that flash, or that is saying that the global economy could still enter a recession. And a lot of this has to do with your PMIs, your yield curve inversion, still showing signs that the worst might not be over. But for now, it looks like the global economy is holding up. Given the backdrop, the macro backdrop, and the markets backdrop that I have presented, we have recalibrated the portfolio. We have increased our risk exposure, increased our tracking error, and increased our allocation to the funds we believe that could participate in the potential recovery. So to cap off, are we there yet? We are very near recovery. But before we get to the recovery, we still have to be careful because we are not out of the woods yet.